Investing in AIM versus fully listed companies. Just a few weeks ago, it was the 20th anniversary of AIM. I'm sure, like me, you got the whole family involved in a celebration, quite a jubilee atmosphere, certainly at our house. And I notice also that for 20th anniversary celebrations, it is traditional to buy China, which is apt in so many ways, is it not? Not only the country, but whatever you buy may well be fragile, overpriced, and prone to smash into pieces at a moment's notice. Let's start with Henry. Are you able, Henry, just in 30 seconds, because we've not got long for this one, just in 30 seconds, can you give us a beginner's guide to the difference between AIM and the main market? What are the differences in terms of the companies and so on?
Sure. So the AIM market was set up, as you say, 20 years ago, and the stock exchange realised there was a gap in the market between startups, which have always had the sort of traditional funding routes of angel investors, etc. But to make that leap up onto the public markets to get equity finance, the rules about how big a company had to be, what sort of track record you had, meant that it was quite difficult to qualify for coming onto the main market. So AIM was set up with more relaxed rules in terms of the kind of companies can come onto the market, that their minimum size is very small. But also they realised that when you're a startup company and you're in a growth phase, you might need to be able to raise money more quickly, so the regulations are less onerous for management when they want to do takeovers or issue new shares, etc. So it's a less complicated system in theory.
Over the last 20 years, AIM companies have generated an annualized return of minus 1.6%. Investors had a 7 in 10 chance of losing money. If you just pick 10 AIM companies since it began, 7 in 10 of them would have lost you money. Worse still, 3 in every 10 would have lost you 95% of your money. Why are we investing in AIM? Tell us the good things about it.
Well, it's certainly true that the headline numbers make for pretty grim reading. It's a slightly abstract number in one sense, because for a start, there's no tracker funds of AIM. You cannot buy the AIM index as a whole. So you, even if the passive side of people couldn't be doing it. But also, it rather confuses the universe of AIM stocks. Now, it is a growth market. There are a lot of startup companies on there, and they're inherently always going to have a much higher level of failure than you would expect to see on the main market, where there's a much more established set of companies on it. So you would expect the failure rate to be higher. It's also slightly covers over the fact that there's a big difference between those AIM companies which have, perhaps because they've come down from the main market or because they've succeeded, have actually got an established track record. So, for example, we did some work for this AIM 20th anniversary. We looked at, well, what happens if you just had a universe of the dividend-paying AIM stocks? It's a very crude proxy for companies which are established, etc. And their performance over the last 10 years, which is, as far as we could get the data going back, was perfectly satisfactory. It was up, I think, 65% over the last 10 years. So it is a complicated universe. It's a universe that rewards stock pickers, that's for sure. But it's definitely not one that you should get involved in unless you understand the level of risks that is out there. And failure rate, etc., is something that you have to take on the chin if you're going to get involved in this index.
You a fan of AIM, David?
Am I a fan of AIM? I don't know, do you want to put the... Okay, that's my top 15 holdings at this current moment in time.
Can we read these out so that people...
I'll go.
So shall I just read them out now? We've got Crawshaw, Ensor Holdings, Accesso Technology, Universe at number 4, Renew Holdings, Inland, RTC, 1PM, Staffline, FW Thorpe, Sprue Aegis, Cambria, Robinson, James Latham, Judges Scientific, and at 16 it's HML Holdings, just in case you can't see at the back.
Now, every single one of those stocks is an AIM company, every one of them. And so I'm in a sense totally biased in that I do think AIM's fine. Although when somebody suggests a company for me to research, I don't say if it's not AIM, I'm not going to look at it. I don't even ask whether it's AIM or full list. I'm interested in the company itself. But it just so happens that the companies that I've got there, at least, well, I know for a fact that all but 2 of those are dividend paying. So there's a good example of where a sensible, company on AIM can do very well. Half of those are actually originally family firms. So either the family name is above the door or they were set up by somebody and effectively just for a family rather than having been inherited into a bigger company and be part of a bigger company. So there's a little bit of a running theme there. But if I go through all those, There's only 2 of them, and there's an asterisk against them. Crawshaw's right at the top, and RTC, which is in 7th. Only 2 of those I didn't hold or had in my top 15 3 years ago. Now, out of those 16 it is listed there, the average return over the 3 years that I've held them, although some were only 2.5 in Crawshaw and RTC, average return 322%. That's 16 companies there, because I've added HML. The 17th company is a fully listed company, so I'm just showing that the top 16 are actually AIM companies. 322% over 3 years is pretty good across 16 companies. So anybody who says to me, I wouldn't touch AIM, I'm not going near AIM, I've heard of all the disasters. I've had some disasters. You know, I've got a wide spread of companies. I think I've had 3 that have completely wiped out over the last 3 years. I've had some that have lost 30 or 40% before I've had a chance to come out of them. But I don't mind. I want to know what's gone wrong, and I want to challenge the companies if something's gone wrong that I think shouldn't have gone wrong. But I think I can take a hit every so often if you know that the ones that you get into and build your stake in, where the management are good, they've got a very good track record of delivering, they're paying dividends, they're doing the right things, they're investing in growth, it's fine. AIM's a good place to be. Because if you take out the resources stocks, you take out the sexy stocks, the stories that are just never going to go anywhere, and I think as Richard made out, there are companies overseas that you shouldn't go near, and there are lots of companies that have, you know, probably come to market far too early or without a clue of where they're going to go to. Eliminate those out of AIM, the rest are actually going to deliver you quite a good performance. If you just picked out 10 out of 100, I think you'll probably find you'll have a good performance.
Leon, is your portfolio stuff full of AIM, or have you got a mixture? Or?
It's a mixture. I mean, most of my ISA was built on FTSE 250 companies, which did very well for a long time. Since I've got to know David, and since the rules on holding AIM stocks with an ISA have changed, then my focus has switched. And I'd say that sort of in my top 10, I've probably got 6 AIM stocks. My largest position is an AIM stock. So, huge benefits, inheritance tax relief, which, you get, as you get older, that becomes more important in your thinking. And no stamp duty. There's lots and lots of benefits in investing in AIM. But for all the reasons you've already said, you've got to be careful and pick the right stocks.
This is a bit of an AIM loving. We're all saying how wonderful AIM is. Are there any problems?
With respect, we're not. What we're saying, I think, and what David is saying, is that you've got to be, with AIM, very, very, very selective. That's what we're saying.
Can we talk about that selection process then? So I'm presuming that all 4 of you have, in fact I know Henry, we talked about this yesterday, Killik has a very stringent process, doesn't it, for selecting, and you just wipe out total, certain sectors go. So tell us a little bit about that.
Yes, I mean, it's slightly, the main area we look at AIM is for our inheritance tax service. So it is a slightly more capital preservation AIM strategy than perhaps just a pure growth one. So what we do to try and mitigate part of the volatility more than anything else, not just the risk of sort of total wipeout, is we ignore mining stocks, basic resources ones, and startup biotechs. It's a sort of strategy that we've approached. And there's a time and a place to invest in those, but given the fact that so many of the ones that are on AIM in those kind of sectors, someone with a spade wanting to get money to go and dig a hole, or a man with a shed and an idea, that's not the sort of thing that we're looking for. So you can take sensible steps to try and reduce the risk of the sort of investable universe that you look at within AIM.
Okay, so let's
to mention EIS relief. So often in those smaller AIM stocks that may be very solid companies, they may be raising money, and you have a chance to get in and benefit from EIS relief, capital gains tax deferment, 30% reduction against your tax, your income tax, and what you're getting, which you don't get if you're buying stocks or buying shares on one of these crowdfunding sites, is that you get great transparency. You've got all the financial history, you get possibly to meet management and take a view. That really is compelling. I mean, it's a real bonus if you're able to get involved in placings involving EIS and solid companies.
So give us, just shout out a few of the things that you just wouldn't touch in AIM, the sort of the things that you guys will just, you know, so for a start, resource stocks, presumably most of you wouldn't touch. Biotech sort of stuff maybe, possibly, I don't know. Can you give us some other examples?
Well, I mean, certainly now, I think the companies that have come from overseas that you just can't get access to, and you don't know, they've got a different culture, you know, they don't really care about AIM, they just want to come over and list and make out that they're a wonderful company because they're on a London market. You know, you keep away from those. Any of the ones that are real sort of going there for ego purposes, you know, it might be, you know, you can tell from meeting the directors that they, you know, they just seem to not really care about investors. They just want the listing. You know, you just got to protect yourself. I mean, all of these companies, and I know I'm harping on something that's already looks like it's made again, but all those companies came to Mello in Beckenham or Mello in London at some point over the last 3 years. So everybody had access to them, and you know, you get to meet management, ask them questions. In a group, you decide whether you think, you know, somebody can say, did you like the way he answered that? Or, you know, get a feel for your company, get a feel for your investment, and really get to know it.
And Lord Lee, I mean, you're going to mention three companies in your FT article, which are fairly recent purchases. We've got Anpario, we've got Concurrent Technologies, and Lok'n Store. What were the sort of the things in those companies that you spotted that elevated them above all the other sort of companies on AIM?
Essentially, Richard, the same fundamental yardsticks, the same characteristics that I look for, whether they're AIM or main market. Companies that are profitable, companies that either are cash positive or have a low level of debt. As David said, companies that are paying dividends, companies where the directors running the business have a substantial stake in the business. And I'm not talking about options, I'm talking about real stakes in the business. I'm looking for companies where the last comment in the latest annual report or similar was optimistic. In other words, one is essentially applying, I would suggest, common sense to investing. And the two characteristics, I believe, for successful investment, and there are only two, common sense and patience. And patience is the most important. And most people, I say this to a lot of people, I say to them, you know, when they're talking the stock market to me, or should they buy or shouldn't they buy, and I say to them, look, you're applying too much intelligence to the problem, too much intelligence. You can worry yourself silly about what may happen to Greece, or ISIS, or the Ukraine, or the price of gold, or what happens in the American presidential election. You know, you can drive yourself silly. You can analyze yourself out of buying anything. I approach it much more in terms of a fundamental way, looking at the individual company, as I said earlier, looking at the individual company, making sure that it ticks all my boxes and that its valuation is acceptable or attractive to me, and then press the button and go ahead and buy. There is no other way, in my view, to do it.
The regulation of AIM can be a little bit light touch, maybe. Let's talk about the whole NOMADS system of regulation, Leon. Can you kind of help us understand it? And also, you know, a lot of people do feel that maybe it doesn't always work.
I mean, I've been involved on the other side of the table where I've helped bring companies to the market, and I've seen the role that the nomad and corporate broker play. And generally, the nomad's role is to check that the company is suitable for listing, and it will, at the company's expense, at the IPO company's expense, employ lawyers, accountants, etc., to do various types of work, and we'll have them report back to them. And there's a verification process where every statement in the documents has to be supportable and supported. So, you know, on the whole, the people I've dealt with have been very, very professional, and yet would I trust the output of all that work? Well, if it was a Chinese company, no, I wouldn't. And the issue is that often a nomad and a broker, they're bringing something to market, they invest a huge amount of effort in that process, a lot of their time. They're looking to say, can I tick the box? You know, if the firm of accountants in Hong Kong has said the accounts are okay, tick. You know, if the legal firm in Guatemala is happy with the contracts, tick. You know, and so if they protect themselves, you know, they end up completely satisfied that they can't be touched. And, you know, do they actually believe that companies are frauds? In some cases, the Chinese one, probably not at the outset. They should be getting a clue now that they are. But nonetheless, they're driven by a different motive. And I think it's very important to always understand what motive is driving any participant in any situation. And they're motivated along one line. You've got to be motivated to protect your capital. It's your money. And you've got to use your own common sense, really, and just think through why, huge companies have Enron and all the others, Arthur Andersen were brought down on the back of that. You know, so, you know, these are, you've just got to use your common sense. You know, it's really what John says.
David, you have often, sometimes gone into battle with companies. So what is it that frustrates you most about AIM?
I think the big problem that most of us see from the outside is the fact that, you know, it's got fairly soft touch regulation at the end of the day. And, you know, even a nomad that I spoke to today said they don't have to do that on AIM. I said, just because they don't have to do that on AIM doesn't mean that they shouldn't do it. Surely to be, best in breed, if you like, best practice, they should try and do something which would be good for investors, you know. And, you know, you come against this all the time. In fact, the nomads, you know, will too often, in my view, find a reason why they don't have to do it, when I feel they should be trying to encourage the companies to do it.
So tell us what sort of thing?
Just reporting things that, you know, should really be in an annual report. You know, could be anything really. You know, they're paid for at the end of the day by the board of directors, effectively paid for by the company. So are they going to really challenge or say no to directors if they can find a way to say yes? You know, it's almost, you know, the responsibility is in the wrong place, really.
And Henry, when we talked, you were sort of saying, well, look, it's not about having lots more rules. It's about enforcing them.
Yes, I mean, it's interesting you mentioned about people saying, oh, we don't have to do that, not part of the best practice corporate governance code. I'm always slightly cynical about people who think, oh, just because I'm following what a committee has drawn up is actually the right thing to be doing. You know, any product of a committee tends to be towards the lowest common denominator, and a lot of the time it isn't appropriate for more dynamic startup companies. So I mean, I think I would say that where there is a regulatory problem, it's where they are slow to enforce existing rules they've got, rather than an absence of rules that we should be having. And I think certainly if you were a bit more, if the regulators were a bit more vigorous in enforcing, and the regulators and the stock exchange were a bit more vigorous, they could have, you know, improved things before they need to start reaching for a pen and write more ones.
Let's throw this open to the audience on the topic of AIM versus fully listed companies. Would anybody like to ask a question? Sir, we'll start off over here if that's all right. And anybody else, if you just stick your hand up, we'll get a microphone to you.
On the question of nomads, as David said, they're paid by the directors, and a really big turn-off for me is if I look back over the history of the company that I'm researching, and there's a series of changes of nomads, because I think there's got to be some sort of disagreement going on in the background, and if a nomad is prepared to let a company go who's paying them, then there's something wrong.
It's a big red flag. Any comment on that?
And you know, every AIM company has to have a nomad, and we'll have a broker as well. You'll be amazed, probably 80% of companies will have the same nomad and broker. You know, they'll claim they're doing it because it keeps the costs down, because they've been offered a cut price deal to do it all in-house with. I hate that. I wish that they were independent. You know, one nomad would be one company and the broker would be another. So they've got completely different roles. You know, one's selling the company effectively, the other one's supposedly monitoring it to make sure they're doing the right things.
They don't make really enough money out of the nomad role, and a typical company will charge 20 to 30,000 for the nomad role. You know, that isn't enough. You can't, you know, is that enough professional time to work out what's happening at Quindell? It isn't. You know, you'd need millions of pounds worth of professional advice to understand that. So I think the reason why they tend to put the model together is that on the corporate broking side, you can earn big fees from raising money from fund managers.
Yeah, but it doesn't mean to say that they have to all be done at the same time by one company. You can still have each of those companies taking on roles that make money, and the ones that just make enough money or a reasonable amount. There are some nomads that are actually only doing nomad work. So if you're saying there isn't enough money in it, why are they doing it at all?
But they're right at the bottom end of the nomad scale in terms of, they've tend to have very few clients, and maybe it's part of their strategy, or that's all the work they can get. I don't know, but it's, I think that there is a fundamental problem that if you want good regulation, you've got to pay for it. And I suspect that shareholders and companies probably aren't paying enough for the level of regulation that I think we need. I think it needs to be much better.
Then maybe to help protect investors and make them a lot more comfortable with AIM, we have to set a level at which it will be paid for. There has to be something that allows it to be done right and proper. The other thing that could happen, I feel, is have a name above the door that is actually so well respected that they'll want to do it right. So why can't auditors actually be nomads? And have all the auditors competing for that work and charging a proper price.
The Stredder stamp of approval above the door. That's
We have a gentleman in the front row wildly gesticulating. Ian, tell us what you'd like to say. We'll just get your microphone, Ian. Let's just get your mic. If you could just...
I think, David, you got it absolutely right. But actually, you go on to the auditors. One of the big problems with the auditors, whether it's main market or AIM, is that they get a small fee for their auditing, and then they get most of their money from the consulting. And that's poacher and gamekeeper. And it's the same with the nomads and the brokers. We have got to split that somehow. And if ShareSoc want to do something really useful, that would be a great thing to start campaigning on and get that split and pay a proper fee so that we are protected as shareholders.
Let's take another question. AIM versus fully listed companies. We've got somebody at the back over there. Let's get a microphone to you, sir.
With the increased risk on AIM, I think three of you have spoken about building a stake. Do you average down building your stake, and over what sort of time frame do you build your stake? Because I've had certain success over the last 18 months. I now refuse to average down when I first enter a company.
Averaging down with an AIM company. Who wants to take that first? Let's go to Lord Lee. Do you average down, Lord Lee, when you're building a stake in an AIM company?
Occasionally, but I'm not conscious that I'm averaging down. It really is a question of trying to build up a holding to the size that I think is appropriate relative to my overall portfolio valuation, how much I want in each individual stock. I mean, I suppose in a way the argument about whether you should have a stop loss or not comes into this. And looking back, I've never really used stop loss until relatively recently. I think had I applied a 20% stop loss, which I think is an acceptable figure, I'd have probably saved myself some losses in years gone by. But if you've got faith in a particular company and you want to build up that holding, okay, if it is tracking down, obviously that should make you a little more cautious. I mean, why is it going down? Is someone else... Clearly, I mean, if you're able to buy, someone, for whatever reason, is selling. So you've got to be conscious of that, a fairly obvious point. But no reason why you shouldn't go ahead if you've really got faith in that particular company.
David?
Well, I mean, every investment you make in every company should be done on that day, deciding whether it's better or good value at the time when you make it. Averaging down is just a title. I mean, Crawshaw's, which is pretty much up at the top there, I bought Crawshaw's shares about 47 times. I looked back the other day before hardly anyone knew about it.
But wasn't it rising when you were buying rather than going down?
Well, it was, but only because the information that was coming out from the company just got stronger and stronger. They're like for likes in the year after the meat problem. Just got better and better and better. So, I felt comfortable investing even more into them. The information was getting better.
But is there a situation where the information has got worse and worse and worse and you've been averaging down? Because the question was about averaging down. So have you ever kind of built up a really big position as the share price has been falling?
Yeah. I mean, so long as I've got confidence in the management, and this is only a temporary, maybe a temporary bit of news that's come out. In fact, sometimes you get news that comes out that everybody automatically thinks that will be bad for that company, and they go selling. Now, I'll ring the company because I've got to know the director, especially if it's one of the larger holdings, And I'll say, is that news really bad for us? I'm not sure, you know, I don't quite, and they'll usually be honest and they'll say, I don't know why everybody's worrying about it. That's actually good for us because of X, you know. And then you think, well, I'm not going to be selling, I'm buying, you know. I mean, you've got to know your company, how it figures into the marketplace.
Leon, what are your thoughts on
I'm an average upper.
an average upper?
I like to be validated, you know, so I make an investment decision. If the market then responds to that by marking the shares up over time, then that's validating my original investment case. You know, if I'm almost never averaged down unless, you know, the market is dislocated and therefore you're having an opportunity of buying a really great business at a much cheaper price, or as David said, if you think that the market has misunderstood some news and has marked it down unfairly.
And Henry, what are your thoughts on that?
I think it's very much a company-specific decision. I definitely agree with the news. If, you know, shares prices sometimes fall without any real justification, and it can be a great opportunity. But you know, it's certainly sometimes it can get. You know, you've got to take courage to do it. I mean, we're discretionary. We only run discretionary funds for our clients, but you know, clients, perhaps ones who don't follow markets very often, you know, they do notice if you buy something that keeps on falling. It's you've got to be able to you know, carry them with you sometimes on that idea. But it, you know, it just depends on what is the cause of the fall.
In small companies, which clearly most of these are, and lots of you will be investing in smaller companies. A small company can only cope with so many share sales in a day without there being some buyers. So if 3 people wake up in the morning and think, I'm going to sell that company because I'm, you know, no longer really interested in it, that price may go down because the market makers or the automatic price setters will say, we've only got sellers, we're going to mark it right down. Then people look at that and think, oh dear, that company's gone down again. They then move in and sell, or they've hit a stop loss and they want to exit. That suddenly has 9 or 10 sellers without any buyers. The price goes even further down. That's a buying opportunity, not a selling creation opportunity.
Lord Lee?
Yes, absolutely. Yeah. But I'd like to add one additional rider to what David is saying, and that is because of the totally absurd rules on insider trading and directors being barred out from buying. I think is it 60 days back from, is it 60 days back now from the publication of results or the announcements, as it were. In some of the small cap situations, the main buyers normally are the directors or senior employees or people who know the company well, almost insiders, and so they who would be normally buying on a weakness in a share price are actually barred out because of the overall insider trading and similar rules. And if there are 1 or 2 sellers, as David said, and the price goes down, there isn't the normal buying mechanism to actually pick up those shares that are available, as it were. And so you do get this artificial price movement down. And so often I find with some of the small ones that there is a very good buying opportunity in that closed period when the directors and friends of the company are really barred out from buying, when there is an artificial dip in the share price.
Leon, you quickly wanted to come on this.
The psychology of averaging down. I mean, if you think about it, we anchor in on something. We're anchoring in on the price that it is at the moment. And psychologically, we're thinking, well, if we can just by buying more shares, which where we originally paid way over the odds, we can bring that price down to something closer to where the current price is. That's in some ways quite satisfying. You think, oh, only another 20 or 30% and I can get my money back and dig myself out of the problem I've got myself in. And I think it's a comforting idea, but it's going to lose you money overall, I think.
One more question on AIM, sir. Should we just get your microphone? There we are.
I was wondering what the panel thought about if there was a difference between AIM stocks and small cap stocks listed on the main market in terms of the amount of institutional interest. So maybe there's less buying pressure from institutional investors. Maybe there's the average valuation may be lower for AIM stocks than for comparable sized companies listed on the main market, and also whether or not the AIM market is more inefficiently priced because there's less institutional interest. I think it's correct that a lot of institutional small cap investors tend not to invest in AIM stocks as opposed to main market small cap stocks?
Henry, this is probably your sort of field.
It's a very interesting question. I mean, we only look at AIM listed ones in our small cap service on my team, and it's certainly true that the smaller end of the main listed market has had some very strong performance for a long time, and it's definitely true that there is more institutional money looking at that. And more index money as well, etc. So I think there's certainly an argument that they benefit from it. But not every company, that comes at a price though of being on the main market, and that's not suitable for everyone. So yes, it comes at a cost of liquidity and institutional interest for being on AIM. But sometimes that is the right thing to do, notwithstanding.
Anybody else want to come in on that, Ludley?
There is in fact a counter argument that some AIM stocks do stand at a higher valuation because they are judged to be good stocks in their own right and on AIM. And so because of the inheritance tax advantages, you get people buying, as it were, whereas you don't get that necessarily with some of the main market stocks. So you can weigh off, you can really balance one factor, the maybe greater degree of institutional interest in the main market, as against the quantity of private investors going in for or specialised AIM funds going in for inheritance tax reasons, and it is difficult. There is no easy answer to that.